let's dive into the two most important docs that you'll need to set up and keep track of. So basically there's two docs that you need to understand. You know how to read them, but also need to keep track of them. And those will be the cash flow statement and the profit loss, that's sometimes also called income statement. Now you might have some sort of something like that, like cash flow statement right now. In any case, at the end of this, in the next videos, I'm going to give you a template and show you exactly how to do this. But in this video, I want to explain what's the difference and what do they all mean and how to understand them and use them correctly. So the first one, what is a cash flow statement? Cash flow statement is basically a document. Both of these documents are going to be some kind of a spreadsheet, right? And so the cash flow statement basically shows what happened in the bank. So where did the cash flow? Did it flow into the account or did it flow out of the account? And the goal of keeping track of this document is to always understand that there's enough money in the bank to pay your bills. Okay, that's why you always need to know what happens in the bank. And as we said in the previous video, if you have a separate bank account, it's rather easy because you can just look at the bottom line, right? How much money there is right now, but you need to understand what happens because you won't predict what's going to happen in a few weeks so that you're not getting yourself into a hole. So here's an example of how a typical few months in a freelancer's life might look like. So let's assume that you have a project, and for that project, which is a $100 project, you're charging 50% upfront and 50% when the project is done, and it's going to take you 3 months, okay, for this example. And you also want to pay yourself $20 salary every month. That's what you need to pay in order to live. Okay, so let's see what happens. In the month of January, we got $50 and we paid ourselves $20, and that's great because we are left with $30 in cash. We have $30 in the bank account at the end of the month. Now let's see what happened in February. So in February, we didn't get any money, and we still had to pay ourselves the $20 salary. But also, let's imagine our computer crashed and we had to buy a new equipment. So actually, we had no revenue in February, and we had $40 of expenses. That actually puts us in a hole, a $10 debt that we now have, which is a big problem. Okay. Now, in the months of March, we got the last 50% of the project, so we got another $50, and we paid another salary of $20. And so at the end of that month, remember we started off at minus 10. We got 50 and then we spent 20. So at the end of March, we are left with $20. So that a lot of freelancers might feel that kind of ups and downs. They have months where they're getting a lot of money, and then there's months where they are not getting a lot of money and they're in crisis, right? Because as we have here, we have a cash flow crisis. We don't have enough money. We might have not, if we couldn't get into debt for that maybe $10, maybe we couldn't have bought this new computer that we needed to do our job. So that's a problem. That's kind of a crisis, okay? So we might think, oh no, our business is in a bad situation. The next doc is the profit and loss. Now, the profit and loss shows basically it's a theoretical model, okay? And it's going to show how much revenue was generated and how much assets were used. Now, I know this sounds a little bit theoretical, and I'll give you the example in a second. Now, the goal here is to make sure that you're profitable and you're running a good business. Okay, so let's see how the same scenario might look on a P&L. So in a P&L, basically what we're thinking about is we had a $100 project that took us 3 months to do. Basically, that means that our work, right, our time, our asset, generated $33 of revenue every month. Okay, we didn't get all that money split equally, but basically that's how long it took us to generate $100. Okay, so in this case, I might consider the project as generating the revenue generated as $33 per month. The salary is how much it costs to use the asset of my time. So that's actually what we do pay. We do pay $20 every month for the use of my time. Now, when it comes to equipment, we did have to pay $20, in February, but the truth is that we bought an asset that we're actually going to use for, let's assume it's going to be used for 10 months. So actually, it's an asset that costs us $2 per month when we're looking at it, because again, we bought it and now this asset is going to be used for a long period of time. So basically, what that means is it means that in January we had a $13 profit. In February we had $11 profit, and in March we had $11 profit as well. So what you can see looking at this is that we have kind of a consistent revenue, but our expenses are slowly going up because we bought something else. So looking at it from a profit loss standpoint, we had originally 39% profit rate, but it was decreased into 33% profit rate. Looking at it this way, I might actually say, you know what, our business is just fine. When we were looking at the cash flow statement, we thought maybe something is wrong that we didn't make money in February, but actually, we're doing just fine. We're generating more revenue every month than we are spending. That means our business is good. So the only thing that we understand here is that our business is in a good, profitable position. We just had a cash flow problem. And that problem can be solved in multiple ways. First of all, the easiest one is imagine that we didn't start with zero. So imagine that in January, we already had $50 in the bank before we made the additional $50. In that case, we had no problem in February, and we just had, revenue going up and down, but everything would be fine. Okay? There are other ways to solve this, and we're going to talk about them in a second. But I want you to understand how these two docs are different. One of them shows what happened in the bank. The other one shows up theoretically how much revenue we generated using our assets, which are time, and how much assets we used in terms of the salary, equipment, and so forth. Okay? Now, we're using the profit loss to track trends. Okay? In this graph, you can see that the trend is that our expenses are going up while our revenue is not going up. Now, at this point, we still have 33% profit rate, which is great, okay? But if this trend is going to continue of us increasing our expenses and not increasing our revenue, that's going to put us in a dangerous position. So we're going to track our trends over time. Now, it's good if the trend of revenue grows faster than our expenses. If our expenses grow faster than our revenue, then we're in a bad situation and we need to fix this. Otherwise, our business is not sustainable over the long term. Now let's talk about how to improve the operating cash flow. And by operating cash flow, I mean the money that we have in the bank that's allowing us to operate, pay ourselves salary, buy the equipment, pay rent, everything that we need to do in order to keep our business going. So the first thing you need to understand is we need to have a positive cash flow. Positive cash flow obviously means we're making more money than we're losing. Okay, you can see that in January we have a positive cash flow. In February we have a negative cash flow, and in March we have a positive cash flow as well. Now, if it's, sometimes we have ups and downs and sometimes we have negative cash flows, it's okay. However, if it's happening every month, then our business is not sustainable and we need to address this as fast as possible, because otherwise we're either getting into debt or we're going out of business. Okay? But realize that in general, the freelance cycle goes, ups and downs, because we're usually charging upfront payment or we're getting, our money at different price points. We're not getting it regularly unless you're doing retainers, which is something good to kind of keep your cash flow consistent. So one thing that you can do, obviously, to fix your negative cash flow is to sell more, generate more revenue, and spend less. Sounds very easy, not always easy to do, but it's something that you need to be mindful of. If you're looking at your cash flow statement and you see that you are negative months after months, you need to think, either how do I generate more clients or what expenses can I start cutting. Now, the next thing that you can do, which is something that might be easier to do, is to reduce what's called account receivable. Now, accounts receivable is basically the kind of accounting term for when do you get paid. Okay, so in this case, we got paid 50% upfront, which some people might say that it's good. You know, a lot of freelancers don't even charge upfront, and we just charge at the end of the project. Think about that. That really puts you in January and February in a negative cash flow, meaning you're basically financing, you know, your client. You're giving them a loan because you need to pay salary, you need to pay for equipment, you need to pay all your expenses until you're getting paid. So one thing that you can do is to think, how can I get paid faster? And you can do that by either asking for a down payment or creating more milestones. And that's part of something that you can negotiate. When you're in the negotiation phase of the project, you'll always want to consider, how do we get paid faster, okay, so that we have positive cash flow. The next thing that we can do is we can increase what's called account payable, which means how many days until we pay. Okay, so in some places it's acceptable to pay what's called net 30, which means that you're getting something and that you're paying something 30 days later. Or another way of putting this is paying with payments. Okay, so imagine you're buying a computer and you're getting it on 12 payments. Basically means that you got the assets on immediately, but you're delayed the payment and you're only paying for, you know, small amount every month. Basically, they financed you getting the asset. Okay, so that might be a way for you to delay payment and have the asset first to help you generate revenue while you're not spending all the cash. Now, you need to understand that there's a conflict of interest here, because you want to get paid faster, and remember that your clients are also business people and are also thinking about improving their operating cash flow. So their interest is to pay you as late as possible, just as we talked right now, which is why they would obviously prefer to pay you only after the project is done, because then they get the cash, they can use the cash, they have a positive cash flow, and they're delaying the payment as late as possible. So you need to make sure to, first of all, acknowledge that, understand that you have some kind of a conflict here, but it's okay. So try to make friends. You have to deal with it in a friendly way, okay? A lot of times, it's not even going to be your client who makes the actual payment. It's going to be maybe somebody in accounting or somebody like that. You need to make sure that you're friends with them, because a lot of times it's just the fact that you're friends and they like you will help you get paid faster. Otherwise, it might be like, oh, we forgot, we lost the invoice, and all kinds of excuses, which are sometimes, again, just excuses to delay payment because they're trying to increase their accounts payable. So make sure you have friends with the people who actually handle the payment. Now, if you have a positive cash flow, which you should aim to have, right, meaning you're making more money that you are spending, then actually you have what's called a free cash flow. That means that you have money that you can either invest by, buying something that's going to help you grow your business, or maybe invest in education or invest in another project, or you can pay your debt, or you can take dividends, which means that you're getting extra money on top of your salary. So that's an amazing thing, and we'll talk about this in the next video.